In today's video, we are breaking down a timely interview with Tom Lee, Head of Research and Chief Investment Officer at Fundstrat Capital. On CNBC's Closing Bell, Tom made a bold statement that caught investors' attention. The market is repricing everything fast, and gold is starting to crush stocks. He explains what is driving the recent price action in equities, how AI is reshaping markets, and why investors feel so unsettled right now. First, I will play the clip of Tom Lee so you can hear his comments directly. After that, I will give you my own reaction and breakdown of what he said and why it matters. Then I will share an in-depth analysis of two red-hot growth stocks that could benefit from this rapid market repricing. If you find value in this video, hit the like button, share it, and leave your thoughts in the comments. Subscribe to the channel so you do not miss the next important investing update. Now, let's hear what Tom Lee has to say.
So what do you make of the price action today? This was a undoubtedly better than expected jobs report. Yields ticked up, maybe expectations of cuts by the Fed ticked down. We're trying to just figure it all out today?
Yes, I think the macro is a little confusing for investors at the moment because we not only have a new Fed chair that's announced and his policy stance isn't clear, but I think investors have been thinking AI was going to eat the jobs market, but we have a pretty decent jobs report. I think it's going to put a lot of weight. And we, of course, had a weak retail sales, but it's going to put a lot of weight on Friday's CPI report, because if that comes in tame, at least the market can understand that the inflation part of the Fed's equation is cooling. And, of course, now if the job market is showing decent strength, it kind of relieves us from a macro perspective, because at least we're not seeing an economic downturn.
How about the fact that the market's been a little frazzled? That's the word I've been using today. Lately. Bespoke points it out. For the first time in history, the S&P went from overbought to oversold back to overbought in a week or less. Goldman's Tony Pasquariello, Tom, says he can't recall a time that was this noisy, this high velocity, this wide open. What about you?
It's very confusing, Scott. I think that there's two things happening, but I think one is really the bigger effect. I think the smaller effect is that AI, as you know, has gone from being this sort of driver of S&P earnings. Now the market questioning, is AI just wrecking tech so badly that it's bad for the stock market? And also, they're not buying the data centers and hyperscalers anymore. They're actually trying to buy the bullets, not the armies. But I think the bigger effect is that gold has become like this singular monolithic trade that's worked. But gold now is a $40 trillion market. X the Mag 7, the S&P's $40 trillion. Gold is now bigger than the stock market. So I think as gold rises, I think investors are wondering, do they really want to use stocks as a store of value if they can just be buying gold?
Man, I just feel like we're kind of going down the line of the AI shooting gallery. And first you take down some of the mega caps, and then you take down a lot of software, and then you take down some of the private credit names, and then you take down some of the financial data related names. Is that just how it's going to be? We're just trying to guess on who's going to be disrupted the most?
Well, I do think AI's capabilities, Scott, are showing improvements, maybe, as they say, doubling every 7 months, and now it's going from mediocre to quite good and substituting some jobs. I think that, of course, is rattling markets. But at the end of the day, and this is a half-full perspective, it's kind of proof of productivity. So to me, I think what we're seeing is that there is a payoff coming from AI, because for software companies, for the ones that are actually truly disrupted by AI, that actually is a cost savings for a client. So I think it ultimately is productivity.
Tom, when someone like David Einhorn comes on today and says, quote, I think this is the most expensive market that we've been in. Can you argue with that? I mean, you can say that it's pricey. Others would say, well, it's justified because look at how earnings are beating expectations. How do you parse that out?
Well, I mean, on a relative basis, his statement is correct because, as the late R. Cashin said, bull markets don't die of old age. They get murdered by the Fed. So every year, the market does get a little more relatively expensive, even if earnings are good. But this year is pretty unique. Earnings growth is accelerating. The ISM is back above 50 after spending basically 3 years below 50. We have a new Fed that ultimately I think the market is concluding is dovish, and David Einhorn actually believes he's dovish. So that's supportive of multiples going up at a time when the stock market has been shown 6 black swans, from all the way from COVID to the tariff disruptions, and still grew earnings. So I think the market's going to have to start to give a higher PE to the equity market, just in the same way that gold's being re-rated at the moment. Gold's PE multiple, price to sales, I think is over 50 times right now. So if gold can re-rate, I think equities can re-rate higher.
Coming into the interview, the backdrop is already uneasy. Bitcoin is falling, yields are ticking higher, stocks are choppy, and investors are trying to interpret a jobs report that was stronger than expected. On the surface, that should be good news. A strong jobs market usually signals economic resilience. But 𝗗𝗏 immediately points out why investors are confused. You have a new Fed chair whose policy stance is not fully understood yet, mixed economic data with strong jobs but weak retail sales, and a market that has been mentally prepared for AI to destroy jobs, not support them. So when a solid jobs report shows up, it creates cognitive dissonance. Investors do not know whether to celebrate growth or fear that rate cuts might get pushed further out. In my opinion, this is one of the most important parts of the interview because it explains why markets feel emotional rather than logical right now. People are not reacting to data itself, they are reacting to how that data might change the Fed's behavior. Everything comes back to rates. Tom makes it clear that Friday's CPI report is the real pressure point. If inflation comes in tame, the market can relax because it checks the inflation box for the Fed. And if jobs remain strong at the same time, it removes the fear of an economic downturn. That combination is basically the soft landing scenario everyone has been hoping for. But then the conversation shifts into why the market feels so frantic and chaotic. Scott brings up how the S&P moved from overbought to oversold and back to overbought in less than a week, something that has never happened before. That alone tells you how jumpy and reactive the market has become. Tom agrees and says there are two forces at work. One is smaller, and one is bigger. The smaller one is AI. The market narrative around AI has flipped very quickly. Not long ago, AI was the hero driving earnings growth. Now the market is asking whether AI is actually destructive to tech stocks, especially software companies, and whether investors even want to own the infrastructure side like data centers anymore. This is where I personally think the market is overreacting in the short term. Disruption always creates winners and losers, but markets tend to overshoot emotionally before fundamentals catch up. AI does not suddenly stop being valuable just because it threatens certain business models. That said, Tom makes a really interesting point about how investors are now trying to buy the bullets instead of the armies. In other words, they want exposure to the tools and components of AI rather than the massive platforms themselves. That shift alone can create a lot of volatility as capital rotates. The bigger force, according to Tom, is gold. This is where the interview gets especially interesting. He describes gold as this singular monolithic trade that has worked consistently, and he points out something that sounds almost shocking when you hear it. Gold, at around $40 trillion in market value, is now bigger than the stock market when you exclude the Magnificent Seven. That is a wild statement because it reframes how we think about capital allocation. If gold is outperforming and being treated as a store of value, investors naturally start questioning why they should tolerate stock market volatility at all. I actually agree with Tom here, and I think this explains a lot of the weird price action we are seeing. Stocks are no longer just growth vehicles. They are being compared directly to gold as stores of value. And when that happens, equities are at a disadvantage because they are volatile and emotionally exhausting to hold. Gold does not have earnings reports or CEO drama. It just sits there. So as gold rises, it quietly competes with equities in a way that most investors are not fully accounting for yet. The conversation then moves into the idea of AI disruption feeling like a shooting gallery, where one sector gets hit after another. Mega caps, software, private credit, financial data companies. The sense is that everyone is trying to guess who gets disrupted next. Tom acknowledges that AI capabilities are improving rapidly, maybe doubling every 7 months, and that it is now good enough to replace certain jobs. That is naturally unsettling for markets, but he frames it in a much more optimistic way. To him, this is proof of productivity gains, and productivity, over the long term, is what actually drives economic growth and corporate profits. This is where I think Tom's long-term optimism really stands out. He argues that software companies are actually the most disrupted by AI, but that disruption translates into cost savings for clients. And cost savings eventually show up as higher margins or stronger earnings elsewhere in the economy. I agree with this perspective, but I also think the transition period is going to be messy. Markets hate uncertainty, and productivity gains are not evenly distributed. Some companies benefit immediately while others get crushed before they can adapt. Toward the end of the interview, Scott brings up David Einhorn's comment that this is the most expensive market we have ever been in. Tom does not really disagree, at least not on a relative basis. He explains that markets naturally get more expensive over time as long as they are not killed by the Fed. What makes this year different is that earnings growth is accelerating, manufacturing data is improving with ISM back above 50, and the market believes the new Fed leadership is dovish. Even David Einhorn apparently agrees with that dovish interpretation. This is a key takeaway for me. Valuations do not exist in a vacuum. High valuations can be justified if earnings are growing and monetary policy is supportive. Tom also reminds us that the market has survived multiple black swan events over the past few years, from COVID to tariffs, and still managed to grow earnings. Because of that resilience, he believes the market deserves a higher price to earnings multiple, similar to how gold is being re-rated higher as a store of value. My personal takeaway from this interview is that the market is not broken, but it is conflicted. Investors are torn between optimism about productivity, fear of disruption, confusion about the Fed, and temptation to hide in assets like gold. Tom Lee's core message is that beneath all the noise, fundamentals are not falling apart. The economy is holding up, earnings are improving, and AI is more likely to be a long-term tailwind than a permanent threat. The problem is that the market is trying to process all of that at once, and that is why everything feels so unstable right now. So if there is one thing to walk away with after watching this interview, it is that volatility does not automatically mean something is wrong. Sometimes it just means the market is repricing narratives in real time. And right now, we are in the middle of one of the biggest narrative shifts we have seen in years. Now, let's dive into the 2 red-hot growth stocks to buy now. The first stock we are breaking down is Nebius, ticker symbol NBIS. Before diving into numbers, it is important to understand why this business matters. Nebius operates at the intersection of artificial intelligence infrastructure, high-performance computing, and cloud services. These are not optional tools for modern businesses. They are becoming as essential as electricity and broadband were in previous technological waves. What makes Nebius compelling is that it is not trying to be everything to everyone. The company is focused on providing scalable, high-performance infrastructure that is specifically optimized for AI workloads. As artificial intelligence models grow larger and more complex, the demand for specialized compute power increases dramatically. General-purpose infrastructure struggles to keep up with these requirements, which creates an opening for focused providers that understand the technical demands of modern AI systems. Nebius is positioning itself as a backbone provider for organizations that need reliable, scalable compute without building everything in-house. That is a powerful place to be. When a business becomes embedded in the core operations of its customers, switching costs rise and long-term relationships form. Over time, this creates durable revenue streams and pricing power. Another important aspect of Nebius is its global orientation. The demand for AI infrastructure is not confined to one region. Companies across Europe, Asia, and emerging markets are racing to deploy machine learning systems to improve efficiency, automate processes, and unlock new products. Nebius benefits from this global demand profile, which reduces reliance on any single market and allows the company to grow alongside the broader adoption of AI technologies. From a strategic standpoint, Nebius is building infrastructure that supports long-term growth rather than chasing short-term trends. AI workloads tend to be sticky. Once a company trains models and deploys systems on a specific platform, migrating away can be costly and risky. That stickiness translates into recurring revenue and long-duration customer relationships. Financially, Nebius has been investing aggressively in capacity and capabilities. While this can pressure near-term margins, it is a classic growth investment strategy. The company is prioritizing scale and technical leadership at a time when demand visibility is improving. As utilization increases and infrastructure costs are spread over a larger revenue base, operating leverage can kick in. What I find particularly interesting about Nebius is that it sits in a space where the market often underestimates future demand. AI infrastructure is not a one-time build-out. Models continue to grow in size, inference workloads expand, and new applications emerge. This creates a multi-year demand curve rather than a short cycle. There is also a defensive element to Nebius that is easy to overlook. As AI becomes more critical to business operations, reliability and performance matter more than marginal cost savings. Companies are willing to pay for infrastructure they can trust. That willingness supports pricing discipline and reduces the risk of a race to the bottom. From a long-term investor perspective, 𝗗𝗟𝗏 represents a bet on the continued expansion of AI as a foundational technology. It is not about predicting the next app or breakthrough model. It is about owning a company that provides the picks and shovels for an entire ecosystem. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let us move on to the second stock, which is NVIDIA, ticker symbol NVDA. NVIDIA has become one of the most important companies in the world, not because of hype, but because it sits at the center of a massive technological transformation. To understand why NVIDIA matters, you have to understand how modern computing is changing. Traditional computing architectures were designed for sequential processing. That worked well for many tasks, but it struggles with the parallel workloads required by artificial intelligence. NVIDIA built its business around parallel processing long before AI became mainstream. That early focus created a technological foundation that competitors have struggled to match. At the heart of NVIDIA's dominance is its ability to integrate hardware, software, and developer ecosystems into a cohesive platform. This is not just about selling chips, it is about providing a full-stack solution that enables developers to build, train, and deploy AI models efficiently. One of NVIDIA's greatest strengths is its software ecosystem. Developers invest time and resources learning NVIDIA's tools and optimizing their code for its architecture. Over time, this creates powerful lock-in. Switching to a different platform is not just a hardware decision, it requires retraining teams and rewriting code. That friction protects NVIDIA's market position. Another key factor is NVIDIA's pace of innovation. The company has consistently delivered new architectures that improve performance and efficiency. This cadence matters because AI workloads are constantly evolving. Customers want assurance that their infrastructure investments will remain relevant as models grow more demanding. From a financial perspective, NVIDIA's growth has been extraordinary, but what matters more is the quality of that growth. Revenue expansion has been driven by real demand from data centers, enterprise customers, and research institutions. This is not speculative inventory buildup, it is end-user demand driven by real use cases. Margins are another important part of the story. NVIDIA's pricing power reflects the value it delivers. High-performance computing is mission-critical for many customers. Downtime or underperformance can be extremely costly. That reality supports premium pricing and strong gross margins. What I find particularly compelling about NVIDIA is that it benefits from multiple growth vectors simultaneously. Training large AI models is one driver. Inference workloads are another. Edge computing and specialized applications add additional layers of demand. These vectors reinforce each other rather than competing. There is also a long-term compounding element to NVIDIA's business model. As more developers build on its platform, the ecosystem becomes more valuable. That attracts more customers, which attracts more developers. This virtuous cycle is difficult to disrupt once it reaches scale. From a risk perspective, it is important to acknowledge that NVIDIA is widely followed and highly valued. Expectations are high. However, valuation alone does not determine long-term returns. What matters is whether a company can grow into and beyond those expectations. NVIDIA's addressable market continues to expand as AI adoption accelerates across industries. Another aspect that often gets overlooked is NVIDIA's role in enabling productivity gains. AI is not just about flashy applications. It is about automating routine tasks, optimizing supply chains, and improving decision-making. These productivity gains have real economic value, and NVIDIA captures a share of that value by enabling the infrastructure behind it. When you step back and look at the broader picture, NVIDIA is not just a semiconductor company, it is an infrastructure provider for the digital economy. That distinction matters because infrastructure businesses tend to have longer growth runways and more resilient demand. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now that we have broken down both companies, here is a question for you. When you compare 𝗗𝗟𝗏 and NVIDIA, which business do you think has the stronger long-term competitive advantage as AI adoption continues to scale globally, and why? Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.